Welcome back to the One Step Better Business Podcast with Mike and Matt. I am Mike. That is Matt. In case you were wondering, today we're going to talk about something that might go off the rails, might be kind of fun.
Yeah.
Top 7 write-offs business owners think are legal, but probably not. We might even throw in a couple of bonus tips here.
Yep.
And so to get this one started, fun question of the day is going to be Matthew Patrick. What is the craziest thing that you've ever seen somebody try to write off?
I mean, try to write off, try to get slipped by, trying to get by us as accountants as we're looking at their stuff. She may or may not have had some plastic surgery done in her midsection, or maybe a little bit above her midsection. She was a trucking broker, and she said it was, obviously to help her appearances to get more work,
win more deals, baby.
I said, yeah, that's not gonna, that can't deduct that one.
Yeah,
that's been the most, that was like instant answer that I think of. I had a couple. I mean, we've had weird stuff like people trying to write off their boats and people trying to say that, the
horses.
Yeah,
that was one that's been recent.
I got, we're gonna make money on these things. I'm like, how?
I think it was a restaurant or something. It was like completely unrelated. Like, my horses.
Yeah. I'm like, no, that doesn't work. I mean, obviously we've had people like, yeah, I bought this boat. We're going to entertain clients on it.
Yeah.
I'm like, what do you do? We're a plumber.
Yeah.
I'm like, I don't think that's going to work.
In Memphis, Tennessee.
There's no lakes anywhere near us.
It was my ocean yacht.
Yeah. We've obviously had weird travel stuff come up. Like, hey, I see that you went to skiing, just you and your wife, how, that's a business deduction. Like, what business? That's not a business deduction.
Yeah.
So that's the kind of stuff that pops up. And look, we're not trying to be the audited police here. We're just trying to tell you what the rules are. There is sometimes legitimate reasons why some of this stuff would be deductible, but a lot of these pretty much aren't most of the time.
Let's start with this one. Let's start with travel. You mentioned, this is one that pops up, honestly, probably pretty regularly, quite frankly. The idea that, hey, I want to, because during my personal vacation, I answered a phone call that was a client, or I sent an email. It's clearly this is a business trip and I want to write the whole thing off.
Yeah.
You're telling me I can't do that?
Not always. So business travel is, ordinary necessary is tied to the business. Most of the time, if there's personal and business travel in that trip, which is, it can happen.
Mm-hmm.
You're supposed to allocate between the two. Like if it was a 7-day trip and, 2 days were business, it would be 2/7 would be a part of those expenses related to that trip would be deductible. Airfare and hotel and all those things. Most of the time though, what we find is, hey, I went out to watch this ball game with my son. And I'm like, was there anybody at work there? No. Okay. What was the business purpose of that trip? And that's where we'll start asking some questions. Now we haven't had, obviously though, we have other people like, hey, I'm exploring. We had one of our restaurant clients was doing some research in the beginning and they went and visited a bunch of different concepts like their own. And they did a big long trip for that. And they had a cost related to that. That's a business trip, right? They were clearly doing now. Was it part of their startup expenses or was it actually deductible now? That's a different equation. But that was research for the business. I don't have a problem with that trip. We've had a client say, hey, I'm looking to expand down to the beach to say that I'm going to open a market there. I went and met with this person and this person, this person over the 5 days. I did that 2 of the days and we'd say, that's fine. Your 5-day trip, I'm going to allocate 2/5 of it to the business. But if you just went to the beach.
Yeah. That's different than every year on spring break, I'm going to go to the beach and
look at a business.
Look to see if I want to expand here. And this is one of those areas that I think that if you have a reasonable business owner and you can look at them and I'd be like, come on, man.
Yeah.
Come on. They know.
And this is, this is being recorded, but pigs get fat, hogs get slaughtered. Hey, that 1 year you did that spring break trip and you did look at that business. There's a legitimate case to make for that being a business trip. Hey, every year you start doing it, you've not opened a business yet at the beach.
Yeah.
So we're going to have a problem understanding that rule. But hey, I'm taking clients to go to the Masters. Okay, well, part of the travel for that trip would be deductible because you are taking clients to the Masters. It's going to entertain. The actual tickets for the Masters would not be, that's one of the things on our list, entertainment. But, The entertainment part of that is not deductible, but the travel would be part of that because it is a business trip. So you have to like look at each circumstance on a 1-by-1 basis. Travel being the one though, there's pretty clear lines. If I'm taking my family to Disney, that's not a business trip.
Yeah. And having honestly good documentation. I actually have
the agenda.
This is the stuff that I actually covered, who was there, what we did, all that kind of stuff. Because under audit, they're going to look for something other than here's my Hilton receipt.
Right. Yeah. And we've had attorneys that have continuing education on cruise ships. That is a thing that happens. The county has as well. Physicians have it as well. And those things have an agenda of what the classes they are attending are. That is a deductible trip. You're just going on a cruise without a seminar attached to it, probably not deductible.
Yeah. All right. So travel, definitely one of those areas that we want to be very clear on why we are doing the thing that we're doing.
Yep.
Especially if we're going to try to write that off.
Yep.
Closely related to that, you kind of brought this up a little bit, is entertainment.
Yep.
You're telling me that I can't every year go to the Masters and buy the best tickets in the house and write that off?
Well, no, not anymore. Used to be where entertainment was 50% deductible.
What does that mean?
I could, if I spent $1,000, I could deduct $500 of it. Nowadays, entertainment is 100% not deductible. So season tickets to a ball game, to the Grizzlies, or to a football game, or whatever it may be, country club dues, all that stuff, 100% not deductible. So tickets are out.
Why do you think that change happened?
It was political, I think, at the time. Ideally, conducting business, wining and dining, those days are kind of past. I mean, taking a client out to a meal and having a business conversation, that's still limited to 50% deductible. Once again, you go spend $100 on a meal, you're going to be able to deduct $50 of it. But entertainment wise, they looked at that and said, hey, that's not something we want to do. And it was also a way to offset another place they were trying to reduce taxes. So it was like an offset number. I can foresee that changing maybe in the future again.
Yeah.
You still have corporate advertising rights that sometimes come with tickets. So if you are advertising in the stadium and you are a big corporation and they're attached some of that advertising system tickets, the advertising would be deductible. The tickets are going to be allocated out and shown as a non-deductible item.
Yeah.
So it's one of those things. Most of the time, if this is something that comes up, as we see, is it egregious? Is it happen all the time? Is it has spending $15,000 every year for season tickets for, Memphis Tigers, all the games or whatever? Probably going to run into an issue where I can't deduct those tickets.
Yep. All right. Another one that you kind of hinted to there is meals.
Yep.
When you say meals, what does that mean?
Well, there's a bunch of rules around meals.
A lot. And this was a topic in the One Big Beautiful Bill as well.
That's correct.
Was changing some things.
Yeah, the One Big Beautiful Bill said even like your little staff meetings and stuff now, like you bring in food to have a lunch and learn. In theory, that's not deductible.
The coffee, that I supply to the office is now no longer deductible.
There's some potential for that not to be maybe enforced, but right now that is the law. It is who's in the meal, what's the purpose of the meal. And like, so one of the things we see a lot of is like 100, if I'm traveling for work, 100% of the meals I take are deductible. Well, actually that's not true. It's still only 50%. Okay. What about Christmas party? Well, that's one, like it's all the employees invited. If it is deductible. It's not even limited. It's 100%. So there's a lot of rules around meals. What we see more than anything though is, hey, me and my wife went out to dinner. Mm-hmm. And I just paid for it with a company card. It wasn't a business meal. That's a 0%. Like I can't deduct that. It's no business purpose of that meal. Now, you and your employee work together in the same business, and there's a business purpose to that meeting, and it's documented. You could justify that meal. So this is one of those things where clients think, well, all my meals that I ever eat with my wife and my family are now always deductible. Yeah, unfortunately, that's not true.
Yeah. This is also one of those areas that you definitely want to have good documentation on.
Correct.
And that documentation is more than just a receipt that I ate a Big Mac at McDonald's.
Yeah, you're supposed to document on there who was at the meal and the purpose of the meal. So like, hey, me and Mike had lunch. When we talked about this purpose, I would be able to deduct 50% of that meal with Mike and I.
Yeah.
Because he's an employee of my firm.
Good just a good practice to get in the habit of is getting that stuff done. All right, that's number 3. Let's go with number 4. This is one that I think is fun. This is one that I don't know what happened, but I vividly remember being in school, going to the University of Memphis, getting a degree in accounting, and this one popped up, and I was like, "Huh, I never really thought about that." Close.
Yep.
Close is one that is quite interesting. A lot of owners think that, hey, I'm wearing a quarter zip. Yep. I bought that quarter zip.
Or work.
That quarter zip has my logo on it. That is now a deductible purchase.
That's a true statement.
The
logo on it helped me.
The logo, but even that is not always cut and dry. That just because I put a logo on it,
correct.
The IRS does not necessarily think that anything that you have with your logo on it is an advertisement that is worth deducting. And so
I don't believe that at all, Mike. That's crappy. No, yeah. I agree. No, it is one of those things. We actually had this happen a lot with attorneys. And this is one that comes up a lot because they have to wear suits for court, and their suits are usually not too inexpensive. And they say, well, I have to have that for court. And the rule there basically is it possible for you to wear those clothings at a time or time and purpose outside of work? So would you wear that suit to church, or would you wear that suit to a funeral, or whatever it may be? If that's the case, it's no longer deductible clothing. We see this a lot in like physical trainers who are like, I bought, clothing with my t-shirts on it and some shorts and shoes. I know deduct all that stuff. No, that doesn't work. Now promo material. So hats and shirts that you're giving to your team, or to clients, those typically would be deductible. But not always necessarily. There are cases where clothing that is for work is deductible. Like say you are required to wear scrubs for work, that would be, or a lab coat, those type of or metal
personal protective equipment kind of stuff. Yeah,
that stuff's going to be deductible. But like just your general, khaki pants, because we have to wear a black shirt and khaki pants at the restaurant or whatever it may be. That's not deductible. A restaurant buying a uniform for an employee would be deductible. So generally, like, hey, here is the shirt that you have to wear. It has our name on it. You have this apron. That's going to be stuff that's going to be done.
Yeah, the thing I think about here that maybe kind of trips people up a little bit is more not necessarily the stuff I'm buying for my team or the advertising piece of it, but it's the stuff that I'm buying for myself as the business owner. Like if I am every day I'm going to wear a polo and khakis to work, and I'm the business owner, therefore that is a business purchase. That doesn't fly. Yeah. And like the attorney is a great example of that. That seems reasonable. Like it is reasonable that an attorney that has to wear like a suit to go to court would be able to deduct that if they, and like that's the part that's like, this is one of those things that, yeah, it feels like it should be one way, but oftentimes it's not. And
it's like
easy to get in trouble.
We've had a situation where like, well, skincare products or, getting my nails done or whatever may be the case. That's kind of similar to that logic. It's personal grooming, personal use. That's not a deductible expense.
Yeah. All right. One that I think might be a little bit of a fun one is if I am the owner of the business, I'm going to pay myself a salary. So can I deduct that?
No. If you're a sole proprietor or a partnership and you're paying yourself a salary, first of all, you shouldn't be doing that. It's not technically correct. But you're not able to deduct that. What you pay yourself, that's one pocket versus the other. They're looking at everything before those pockets. So what's left before you pay yourself. So that is one that we've had come up, and we've had, we walk them through what they're overpaying usually when that happens. They're, FICA and Social Security, unemployment, all the things that go with payroll. But additionally, they're not able to deduct that. And they think we have seen it when we picked up a new client, we've seen it deducted on returns before. And I'm like, yeah, that's not, you can't deduct what you pay yourself because you're not picking up the income on their side. There's a lot of stuff around there, but it has definitely come up. We have had people like, I don't understand. I have to pay myself. I'm like, yes, you do, with what's left before you pay yourself. That's the profit.
Yeah. And that one is, can be a little bit confusing, especially because entity type starts to matter there. There's a variety of things that can throw wrenches in that one. All right, next one up, numero 6. This is going to be a fun one. I was going to say travel. We already talked about that. Not necessarily travel, but like I I used my business bank account to go buy a new truck, and I'm going to use that truck in my business. And I'm also going to use that truck to go on vacation and do all my normal stuff. So can I just write off that entire truck?
No. Vehicles follow two rules. You have actual expenses, or you are deemed to have a mileage allowance. And mileage allowance is set every year by the IRS. It's somewhere around 60 cents a mile now. I don't know exactly what it is this year. But you only get actual business expenses attached to your truck as a percentage of your total miles driven in a year, divided by, how many business miles. So let's just use round numbers. We drove 10,000 miles this year. 4,000 of those were business. I'd only be able to deduct 40% of the cost of that vehicle. So if I had direct expenses of gas and oil changes, and even get my car cleaned, and the interest on my note payment, all the things within it, I'd take 40% of that. And then the depreciation of that vehicle. So I spent $40,000 on the truck. I'd only get 40% of the depreciable amount I was supposed to get, because that's my business miles as a percentage of my total miles. Or I can say, hey, these are all the business miles I drove this year, and we'll use 60 cents as the number. Hey, I drove 10,000 miles, total miles, and of which 4,000 of those miles were for business. I'd multiply 4,000 times 60 cents, and that would be my deduction. That would include everything in that pile. It's whatever the grader is, but once you pick a method, you get that method. So you're never going to probably get 100% business use if you also use that vehicle for personal use purposes.
So then how do you define business use versus personal use when it comes to your own vehicle?
Yeah, that's even more importantly. So anytime you're driving the vehicle for work purposes, not including your commute to and from work, would you get to deduct those miles. So let's say I drove to work every day, and then from there I had to go do my meetings or whatever I had, go to the post office, go to the bank, whatever it was. Those miles during the day would be business miles. And then at the end of my day, going home, I don't deduct those miles. So we've talked, there's a couple good apps. Mile IQ is the one I kind of recommend. But you're going to basically tag each trip and mileage that way. We will talk through some strategies around maximizing that. So like, hey, make sure you go to the post office on the way to work. Make sure you go to the bank on the way home from work. But you're talking about the grand scheme of things, not a lot. Real estate agents, where we see a lot of this, their day starts if they're working from home and they are going to their first client appointment, they don't have a normal daily commute. So their day would start from home.
Yeah. And so with that, then, if let's say that I'm going to go mileage and I'm tracking my mileage, are you telling me that if I go buy $100,000 Lexus, I get the same 60 cents if I go buy a $30,000 Focus?
Exactly right.
Well, that sucks.
Yep. Now, so that's where we look at actual expenses, and it may be better off to choose actual expenses, but you have to think about this in the long run. At the end of the day, they're probably going to work out about the same, because your mileage number at the depreciable rate you have versus with depreciation and gas and oil change, all that stuff being combined, they're set up to be equivalent.
Yeah, that's the whole intent
the whole point
of
the
mileage,
number. Yeah.
Make it easy. So the other thing that you often hear, or we even see, is if I put my company's sticker or wrap that car, then now all of a sudden it's an advertisement and I can fully deduct that.
Yeah, same problem. You still only have business purpose miles and personal purpose miles as deduction. You're going to deduct the amount of the wrap, or you'll be able to deduct the amount of the sticker or whatever you put on your car as an advertising expense, for instance. But if you're still only driving that truck, during the day, job to job or whatever, that's the only part you're actually able to deduct. It's not now always an advertising. I don't have a moving billboard because of that. It doesn't work that way.
Yeah. And that's honestly, you see that on TikTok a lot. Just go put a sticker on your car. Next thing you know,
it's all 100%. And it's 100%. I'm always driving my billboard now.
That's right. Yeah. I just saved you $10,000 in tax. Or you put me in jail. All right. That's 6 out of the 7. So we got to come up with one more. This one's probably going to be a fun one. Remember, it's the top 7 write-offs that business owners think are legal, aka legit, but they're not really. You mentioned this one earlier.
Always.
Not always, yeah. There's other things you got to consider.
Yep.
Gifts for clients.
Yeah. I would imagine that most business owners, hey, new client came on board and I gave them a thank you gift for coming on board. And it includes a couple books and maybe a couple shirts and whatever and that totals up to $50 or $75. The technical answer here is it has not been indexed since 1986 that I'm aware. So it's obviously a little dated. It's still $25 per client per gift. So I could give them multiple gifts during the course of the year. I'm not even sure that's 100% true, but I know the limit is $25 at a time. So like you give them a $100 gift card for, hey, thank you as this referral or whatever it may be. That is not 100% deductible. I'm only going to deduct up to $25 at a time.
Yeah. Yeah. And that one's a little bit, on one hand, it makes sense. It kind of, hey, I can't gift you tickets to the Red Sox,
but here they are.
But, it kind of falls in line with some of that entertainment stuff in a lot of ways. All right.
Any of my clients who want to gift me
season tickets to the Red Sox,
I'm in. I'll worry about the tax consequences later.
Yeah, there you go. This is being recorded. 7. That was number 7.
That was number 7.
Right, bonus tip. I think this is a fun one. So here's what I'm going to do. I got a dog. Her name's Charlotte. Charlotte is a really good barker. Because I have to feed Charlotte, I might even want to put her on payroll because she's such a good employee of mine. I'm going to employ her as my security guard. So can I start to deduct everything that's related to Charlotte because she's my security dog?
I would say probably not. Knowing Charlotte, I'm not sure she's going to attack me to the point. I would assume if I've had a dog who's been let's say I have
a canine German trained
canine German Shepherd or a Doberman or something securing my facility. Yeah, that may be different. But if I just have my random golden retriever, that is now my service animal and it's my protection, probably not going to be able to deduct that. We've seen clients try to run pet insurance through and cost of pet surgeries. Unfortunately, pets aren't deductible.
Yeah, that stinks.
Yep.
Well, it sounds like today,
no love by the pet lobbyist.
Today I learned all the things that I want to be able to deduct as a business owner, and yet I cannot. So that was a bit of a downer episode. But this is super important because these are the things that, you get audited, very well could get you in trouble. So make sure that you avoid this kind of stuff. If you enjoyed our episode, this is the kind of stuff that we talk about all the time on the podcast. So make sure you subscribe to that. Also, we write articles every week that's similar to this. So check that out at patrickaccounting.com. Click on Learning Center and you'll find everything that we've ever done. Thanks, everybody. Have a great day.